Okay, so this is also we are going to solve an exams likely question on consolidation. Maybe this video will be two parts. Hopefully, we are able to get somewhere. All right. So let's start without wasting much time. So it said the statement of profit and loss and other comprehensive income of Lucky PLC and Super PLC and Adum PLC for the year ended 31st December 2024 as follows. So we have Lucky PLC, Super PLC, and Adum PLC. So this was the income statement, and this is the financial position. Now, what does it say? It says that, so let's take the additional information one by one. After you read the additional information, then we'll start the question. All right. So let's just read the additional information. Then I'll show you the processes. So it says that, so basically the requirement is that prepare the consolidated account of profit and loss and other comprehensive income for the year ended 31st December 2024 and the consolidated statement of financial position after 31st December 2024 of the Lucky PLC Group. You are going to prepare the consolidated statement of financial position. You are also going to prepare this consolidated profit and loss and other comprehensive income. Now, what does it say? So before that, let me come here, right? Let me explain some things. Now, under consolidation, right? So basically, there are some workings you are supposed to do before you start any consolidated or any consolidation exams question, right? So the first one is that always remember that you are supposed to find out the group structure. So now this group structure, right, can be the relationship between a parent and a subsidiary, or a parent slash an investor and an associate. So when it comes to a parent and a subsidiary, I think that there's a parent and a subsidiary relationship if the person acquires 50% or more of the shares, and there's a associate or parent and associate relationship if the acquisition is between, or the shares acquisition between 20% to 49%. So basically it's more than 20, more than or equal to 20, but less than 50. So this is where we are seeing that there is a parent and an associate or relationship. So always take note that under group structure, right, after you've identified the percentage of the interest, right, what you're going to do is that always remember to state your pre-acquisition period and post-acquisition period under group structure. Always remember, right? So I'll use this question to just do all this. So always remember that I'm supposed to state your pre-acquisition period and your post-acquisition period. Now, the second one is that you are supposed to find the net asset of the subsidiary. Net asset of the subsidiary. So when it comes to the net asset of the subsidiary, let's do something here. So always make sure that you start with the equity side. So equity side has stated capital, it has retained earnings, right? Now, we have net assets of the subsidiary at acquisition and at reporting. Now, what I'm going to do is that with the net assets of the subsidiary at acquisition, always take note that the share capital or the stated capital at acquisition and at reporting will always remain the same. Take note of that. So what I'm doing is that when it comes to net assets of the subsidiary, you always start from the equity portion. So always look at the adjustment of the equity portion before you come to the additional information. So you start with the share capital. After you go to the share capital, then you move to retained earnings. Now, the retained earnings at reporting is always the same thing in what the statement of financial position. But to get your retained earnings, at acquisition, right, is going to be the retained earnings at reporting, minus the post acquisition profit. So minus the post acquisition profit. So this post acquisition profit is more like minus the profit that occurred in the post acquisition period. So basically, this post acquisition profit is gotten by multiplying the number of months that you came to meet. So for example, if you acquired the asset 1st June, right? So let's do 1st July, so that it will be 6 months. So it means that you acquired the asset 6 months into the year, or you acquired the subsidiary 6 months into the year. So it means that you are left with 6 months to the end of the year, right? So it means that the post acquisition period is 6/12 months, basically. So what it means is that the post acquisition profit is 6/12 times the profit that they made for the whole year. So it maybe they made a profit of maybe 4,000, right? Then you multiply this over 12 times for the profit of 4,000. Then that will be it. Then you subtract it from the retained earnings at the end of the year. Then that balance come here. Now take note of this. If there's profit for the year and there's comprehensive income, always remember to choose your comprehensive income for the calculation. For this question, for example, there was profit for the year and there was comprehensive income. So we are going to use our comprehensive income for our calculation for the post acquisition profit. The subtraction of the post acquisition profit, that side. That we are going to use to find our retained earnings. Now after you do the equity portion, right, you do what we call the fair value adjustment. That is if there's any adjustment you are supposed to make. So you look for the additional information, look at if there's any adjustment relating to a net asset, right? So if you are supposed to add the fair value, add it. If the fair value was rather supposed to be subtracted, we subtract it. Now after I done your fair value adjustment, then you less depreciation. Now depreciation occurs at the end of the year. So you less depreciation at the end of the year. Now after this, now the other thing that will come here, right, is when there is an intra-group sale. Now let me explain intra-group sale before I even continue. Then after intra-group sale, I'll start with the work. Because I think else the video will be long. But intra-group sales is what is needed, because usually people get confused of it. So now intra-group sale, right, can happen between parent and subsidiary. So that's the parent sells to the subsidiary. So let's take that instance. Now if the parent sells the subsidiary, these are the entries. Now always note that if the parent is selling to the subsidiary, look at the sales that happen in the post-acquisition period. So always make sure that the sales that is happened in the post-acquisition period, because that is what we are eliminating. You are not going to eliminate the sales that occurred before the acquisition. So always make sure that the sales that is occurred in the post-acquisition period. So if the sale occurred in the post-acquisition period, the entry is that you are supposed to debit your sales revenue. Alright. Then you credit your cost of sales with the sales value. So let's say that the parent sold to the subsidiary, right? Then for a value of 400,000 the post-acquisition period. So basically what you do is that you debit the sales revenue 400,000, then credit your cost of sales 400,000. Debiting sales revenue basically means is that your sales revenue is going to reduce, because sales revenue has a credit balance, so it's going to reduce. Now cost of sales is an expense which has a debit balance, so crediting means that you're also going to subtract your cost of sales. Now the other entry, so there are two entries here. The other entry is that you are supposed to find if there's any unrealized profit. Now the unrealized profit will be calculated on unsold goods. So if there are any goods unsold, you calculate your unrealized profit, right? Then you use the unrealized profit for entries. What is the entries for unrealized profit? Now also take note that the unrealized profit is your margin percentage times the unsold goods, the value of the unsold goods. So if it is markup, you are supposed to change the markup to what? To margin. How do you change markup to margin? The markup to margin is just markup over 1 plus markup. This is how you change markup to margin. So if the markup is 25%, the margin will be 25 over 1 plus what? 25%. So that will basically give 20%. So you have a margin of 20%. Then multiply the 20% by the unsold goods, and that will be unrealized profit. Now, the entry for the unrealized profit is for you to debit your cost of sales, credit your cost of sales, then you credit your inventory. So you debit your cost of sales, then you credit what? Your inventory. You debit your cost of sales, then you credit what? Your inventory. Now, aside this, because you are debiting cost of sales, now we are supposed to also reduce, right? Take note. We are also supposed to reduce either. So we have two options here. So when it's parent to subsidiary, then you are also supposed to reduce the group retained earnings. By the unrealized profit. So when it comes to parent subsidiary, this is what you do. First, debit sales revenue, credit cost of sales. So you debit it with the value of the sales. You get it? Now, then you find the unrealized profit on the unsold goods. So basically what it means is that you are supposed to find the unrealized profit by multiplying the margin percentage by what? The unsold goods. After you find the realized profit, you now debit the cost of sales with the unrealized profit. So this one you are debiting with the unrealized profit. Then you credit your inventory with also what? The unrealized profit. So debiting cost of sales means that you are increasing your cost of sales to the unrealized profit. Then crediting inventory means that you are reducing your inventory to the unrealized profit. Then the further entry is that you are supposed to reduce the group retained earnings by the unrealized profit. So when it's parent to subsidiary, there are 5 entries. Okay, debit sales revenue, credit cost of sales. Then you debit cost of sales to the unrealized profit. You credit your inventory to realized profit. Then reduce the group retained earnings by what? The unrealized profit. So when we solve the question, this will make sense. Then if it's from subsidiary to parent, right? So the instances are the same. So you debit sales revenue with the value of the sale. You credit cost of sale with the value of the sale. You debit cost of sale with the unrealized profit. You credit what? Inventory with the unrealized profit. Now, the only difference between sales to parent and sales to subsidiary is that when the subsidiary is selling to parent, you have 2 options. The first one is that you are supposed to either reduce the net asset of the subsidiary by the unrealized profit, which is the first one. The second one is that you share the unrealized profit between the NCI and the group retained earnings. Right. So what I'm saying is that when the sale is from parent to subsidiary, the entries are the same between the sales from parent to subsidiary and the sales from subsidiary to parent. The only difference is that if it's from parent to subsidiary, the other entry, which is the 5th entry, you are only going to reduce the group retained earnings by the unrealized profits. Now, if it's from subsidiary to parent, the 5th entry, you have 2 options. It's either you are reducing your net asset of the subsidiary by the unrealized profit, or you are sharing the unrealized profit between the NCI and what the group retained earnings. But this is more advisable to use. Like, this is more simple to use. So always, what we are saying is that if the sale, the intra-group sale, is from parent subsidiary, the entries that will be affected: debit sales revenue, credit cost of sales, debit cost of sales to the unrealized profit, credit inventory with what? The unrealized profit. Then you reduce group retained earnings if it's from parent subsidiary. If from subsidiary to parent, debit sales revenue, credit cost of sales, debit cost of sales, credit inventory. Then you reduce net assets of the subsidiary. So the only difference between the two is that when it's from parent subsidiary, you are reducing what? Group retained earnings. When it's from subsidiary to parent, you are reducing what? Net assets of what? The subsidiary. So from parent to subsidiary, you are reducing what? The group retained earnings with unrealized profit. Subsidiary to parent, you are reducing what? The net assets of the subsidiary by what? The unrealized profit. Hope that is fine. Now, if the sale is from the parent to associate, now what happens is that we treat the associate as what? As a third party transaction. Now what happens is that, what it means is that, you see how we eliminated the value of sales here? When it's from parent to subsidiary or parent to associate, we do not eliminate the value of the sale. So for example, if maybe parent sells to associate for 400,000, right? We are not going to eliminate the 400,000. We're only going to find the proportion of the goods that were unsold and find the unrealized profit. And it is unrealized profit that will eliminate. So when it is from parent to subsidiary or parent to associate or associate to parent, right? The only elimination, right? The only elimination is going to be on or with the unrealized profit. Now, this unrealized profit, to take note that you are going to find just the parent's proportion of the unrealized profit, and that is what you are going to eliminate, because you are only consolidating with the parent. So we are not going to consolidate the associate. So you only find the proportion of what? The parent unrealized profit and what? And eliminate. So the entries, if it's from parent to associate, these are the entries. You debit the group retained earnings with unrealized profit. Then you credit investment in associates with unrealized profit as well. Then the last one. So always remember that if you are treating the unrealized profit, it's 3. For example, here, the unrealized profit was treated by debiting cost of sales and crediting inventory, then reduce the group retained earnings. From subsidiary to parent to, we debit cost of sales and credit inventory, then we reduce the net assets of the subsidiary. When it comes to the parent to associate, since you're only dealing with unrealized profit too, we debit group retained earnings of unrealized profits. We credit investments in associates of what? Unrealized profit. Then the last entry is to increase your cost of sale. So you debit your cost of sale with also what? The unrealized profit. So if it's from parent subsidiary, this is the entry. Now, if it's from a parent, for a parent to associate. Now, if from associate to parent, that one to also eliminating just what? The unrealized profit. So that one we also debit the retained earnings of associates. Now, we have to take note that we are only dealing with consolidation of subsidiary, when we are not doing consolidation of what? Associates. So in this instance, the debitor of the retained earnings of associate will not have any effect of what? Our consolidated financial statements, because we are not consolidating with the associates. Then after debiting retained earnings of associates, we credit inventory of the parent. So in this instance, the inventory of the parent will be affected because you are consolidating the parent. So it means that you reduce the inventory of the parent by what? The unrealized profit. Then, as I said, whenever it comes to unrealized profit, there's always a third transaction. So what is the third transaction? You reduce the parent's share of the the associate's profit. We reduce the parent share of the associate profit by what? The unrealized profit. So basically, what it means is that wherever you see the parent share of the associate profit, you reduce it by what? The unrealized profit. But this has a caveat, right? Where when it comes to investments in associates, even though we are going to add the parent share of associate profit, we don't reduce the parent share of associate profit and the investments in associate by what? The realized profit. So I think if I talk a lot, it will waste time.